Hello, fellow Rebel Capitalists. Hope you're well. Let's get into this article. New from Zoltan Pozsar, our favorite analyst with Credit Suisse. He is talking about the inflation rate, and his opinion, his prediction, is that the Fed will have to take interest rates up to almost 6%. Now, I'm not talking about the 10-year. I'm not talking about the 30-year. I'm talking about Fed funds up to 6% in order to bring inflation back down to the Fed's target level of 2%. But let's get into this article and see what Zoltan is talking about. Here we go. From Bloomberg, Fed may have to hike rates to 5-6% as inflation now structural. So, you would think a debate on inflation would be rather straightforward. You just kind of have the supply side, then you've got the demand side. But as you get further and further into the weeds and think about the nuance, it's by no means straightforward. There are so many variables that if you really start peeling back the layers of the onion, it's actually tough to get your head around. And I know because I did a whiteboard video this morning on interest rates and if the Fed can keep interest rates artificially high, if they're not too high. Who knows? We know they keep them artificially low all the time. I did that video yesterday trying to just go through my thoughts out loud. But again, the point is when you get into the weeds with inflation, interest rates, and what impact the Fed has on the long end of the yield curve, if any, it just really gets tough to get your head around. So one of the reasons I really liked this article is we tend to get into the weeds on the demand side. Stimmy checks, government spending, maybe you could throw the Fed monetizing the debt if you want to include that. We could talk about the government reducing the expenses for most Americans with the mortgage forbearance or the student loan forgiveness or forbearance, whatever the heck it's called, the rent moratorium. But we don't often get into the weeds on the supply side. We just say, well, the government screwed everything up in 2020. That's a given. And the supply chain just really haven't fixed themselves since then. But Zoltan gets a little bit more into the weeds on the supply side, which I really appreciate because that adds even another curveball. That adds even more nuance into the outlook of probabilities for specific outcomes. It says the U.S. may need to undergo a deeper and longer recession than investors currently anticipate before inflation can be brought under control, according to Zoltan. So the market expects the surge in consumer prices will peak. Central banks will become less hawkish. But there's a high risk that global cost pressures, so this is when he's getting into the supply side here, will remain elevated. Pozsar, global head of short-term interest rate strategy at Credit Suisse New York, wrote in client note, the world is being racked by an economic war that's undermining the deflationary relationships that have prevailed in recent decades, where Russia and China supplied cheap goods and energy, maybe, and services to the developed nations like the U.S. and Europe. War is inflationary. Think of the economic war as a fight between consumer-driven West, where the demand has been maximized by, and that's the demand side we always talk about, that I was discussing just a couple minutes ago, that we get into the weeds all the time. But now he's layering over top of that, we've got the production-driven East, where the level of supply has been maximized to serve the needs of the West. That pattern held until East-West relations soured, which, as you guys know, doing very quickly. That isn't news to anybody. That with Russia, China, India, Saudi Arabia, potentially Brazil, that the relationship we had just, let's call it 4 or 5 years ago, is deteriorating rapidly. So he says that these relations have soured and supply snapped back. These supply chains have been destroyed, and they're probably not going back to where they were just even in 2019 anytime soon. And this goes back to the argument that my good buddy Chris McIntosh, one of my partners in Rebel Capitalist Pro, makes all the time. Usually, the cure for high prices is high prices. But this time, famous last words, it may be different. Because if you think through why that saying is true, as prices go up, more capital goes in to creating more supply and demand goes down. Therefore, you get this equilibrium where the additional supply, lower demand brings down price. But now we're living in this environment where even if you're throwing capital at the problem, or maybe there won't be capital thrown at the problem because of the supply chain disruptions, because of virtue signaling, and because that relationship has just deteriorated to the point where the capital isn't going to invest in the countries that can produce the additional goods and services needed. Oh, I should say the additional goods and energy needed. So it's not like, okay, high prices are going to cure themselves, because the dynamics behind why that's typically true have been broken. The result is inflation is now a structural problem rather than a cyclical one. Now, this is on the supply side, I think, a very interesting idea. Supply disruptions have arisen from the challenges in Russia and China, along with tighter labor markets due to immigration restrictions and reductions in mobility caused by, well, let's be honest, caused by the government's response to the cerveza sickness. None of this was caused by the cerveza sickness. But we always have to be very clear. It was the government's response to the cerveza sickness. If the government wouldn't have locked you in a cage for 6 months, a year, 2 years in some places, we would not be having these problems, or we wouldn't be having them to the degree to which we have them today. Again, this is a thought experiment I do all the time. It makes things very simple. Let's just imagine the governments globally never locked their citizens in a cage. Let's just say they said, you make your own decision. Here's the data we have on the cerveza sickness. It's not the flu. It's bad, at least the first scariant, let's say. And we'll get back to you. We would suggest you stay inside. We would suggest that you close your business. We would suggest you do these things. But at the end of the day, it's your private property. So if you want to open the doors to your business, that's your right. At least you know the risks involved. If they would have taken that approach, combined with never sending out any stimmies. This is the free market. This is a force majeure type of event. And it is what it is. We've got to let the free market work and figure things out. And the people that didn't have adequate savings, as far as the entities, the businesses, they're going to go bust. And the entities that did are going to take them over. And we're going to let Schumpeter's creative destruction play out. If that would have happened, what is the probability that we would be at 9.1% CPI in the United States right now? Other than zero. And I say that as someone that constantly pounds the table and says there are no certainties, only probabilities. But that one thing that I'm as close to certain as I possibly can be, we would not have a 9% CPI print if the government would not have locked you in a cage, if the government would have let you make your own decision, and if they would not have sent out stimmy checks. Period. Bottom line, end of story. So enough of my rant. Let's get back to the article with Zoltan. There's now a risk the Federal Reserve under Chair Powell has to raise rates to 5 or 6% to keep them there to create substantial and sustained reduction in aggregate demand to match tighter supply profile. Now, here's where I disagree. I don't think that they need to take rates that high to crush aggregate demand to the degree that is needed in order to bring down prices. Maybe not to 2%, but at least get them trending down to see some disinflation. Maybe we go from 9, 10% down to 7, 6, 5, something like that. I think the argument on the supply side, though, is great. I think supply remains tight. Therefore, the Fed, boy, even if I'm thinking this through, even if the Fed took rates to Fed funds to 4% or something, 3, 4%, I still think that would crush demand to a point where it would start to bring down the level of price inflation. Wouldn't have deflation, but it'd start to bring it down, even with the supply chains being as screwed up as they are. That said, let me play devil's advocate. And this goes into some of the research I did today for the whiteboard video. What is the main interest rate in the economy that a lot of other interest rates are a derivative of? That'd be the 10-year treasury. So you guys know mortgage rates, as an example, really tend to follow. They're not in lockstep, but they tend to follow the 10-year. And a lot of other interest rates within the economy. You could say corporate debt to a certain degree. You could say maybe car loans, credit card debt. It's not, once again, it's not going to be like a 1-for-1 ratio, but they're going to be close. This is why, and most people aren't talking about this, but it's why we have seen mortgage rates go down since June. Down. They peaked out at like 6.2%. Now they're under 5. How? How is that possible when the Fed has been increasing interest rates, when the CPI has gone up? Well, it's possible because the 10-year is going down and the mortgage rates are following the 10-year treasury yield. So why is the 10-year treasury going down? Because as the Fed increases rates, future inflation expectations are going down. It goes back to something called the Fisher effect, which I outlined specifically in today's whiteboard video. So the bond market, the long end of the treasury curve, the 10-year, is predicting lower rates of inflation. That's why as the Fed increases rates, you actually see the 10-year yield go down. Remember, the 10-year 3 or 4 months ago was at like 3.3%. Now it's at 2.6% as the Fed has raised rates and as the CPI print has gone higher and higher. So why? Because as the Fed raises rates aggressively, it's predicting that there's a higher probability that we get disinflation sooner than later. The Fed brings on that recession. Okay, so my point here is, let's assume the Fed keeps raising rates and that increases the probability we have a recession and disinflation. So inflation expectations go down. Well, you would expect the 10-year treasury to go down. So we're in this weird, bizarro world where the higher the Fed takes the front end of the curve, the lower the 10-year goes, potentially. Well, the lower the 10-year goes, the lower the rates in the economy go. Well, how is the Fed fighting inflation if the interest rates in the economy are actually going down? That's the whole point of bringing up the front end of the curve in the first place, to increase interest rates. So it's almost like the only way the Fed could increase rates right now is if they, and I'm talking about the 10-year and the rates in the real economy, is if they actually lower the front end of the curve, if they lower Fed funds. That's just me playing devil's advocate. And that Zoltan is saying they need to get up to 5-6% to smash inflation. And I'm saying maybe, but maybe not, because maybe taking rates up to 5% would actually reduce the rates in the real economy. Because again, the rates in the real economy are based on the 10-year, where the Fed is only taking up the front end of the curve. And that makes the probability or the future inflation expectations go down. Therefore, so does the yield. Potentially. And I'm not saying this isn't a prediction. This is just saying this could play out based on the market dynamics we have seen over the past couple months, which would be easily explained by the Fisher effect, which is simply real rates of interest equal nominal rates minus inflation. But the key there is inflation expectations, right? So this is the argument here from Irving Fisher is investors are going to need a real rate of return. If they demand a real rate of return, then if you have the 10-year treasury at 3%, that would imply that future inflation expectations are less than 3%. Because if future inflation expectations are more than 3%, then based on the equation, there's going to be a negative real interest rate or negative real return, a decrease in purchasing power. And investors aren't going to accept that. So the fact that we have the 10-year at 3% would imply that future inflation expectations are less than. So let's just say 2%, which would give the investor a real return of 1%. So I don't want to go into it in any more detail. I'm sure your heads are spinning right now, but I explained it very thoroughly on today's whiteboard video. It'll probably be out tomorrow. Getting back to the article, the bond market is misguided now than at any other time this year, as traders wager the U.S. Central Bank will start cutting rates in early 2023. Yeah, I hesitate with that because trust me, when I look at the bond market right now, it doesn't make sense to me either. I don't see how we can have CPI at 9%. Well, I do, but it's. I mean, I wouldn't buy a 10-year treasury, that's for sure. So I totally get both sides, both arguments. But if I'm going to push back on Anna Wong here, she's the chief economist at Bloomberg, I guess. I would say, how often in the past has the bond market got it wrong as far as future inflation expectations? It has here and there, but usually the bond market gets it right. Like I use the example of a hitter in baseball. If you've got a guy that hits a home run 90% of the time and he's at bat, are you going to say, oh, well, this time it's going to be different? He's going to strike out for sure. It's just he's got the bond market's got it wrong. Okay, definitely a possibility. But the chances are that the dude's going to hit a home run because he hits a home run 9 out of 10 times. Likewise, the bond market hits a home run 9 out of 10 times as far as its predictive ability, especially when you look at the entire treasury curve. So although it doesn't make sense, we have to acknowledge what the market is telling us. That's one of my main points. Interest rates may be kept high for a while to ensure rate cuts won't cause an economic rebound. So I think what they're talking about is really an inflationary economic rebound. So think about an L instead of a V. So let me try to decipher what they're saying. We've got 9% inflation, and they're going to try to keep rates high. So if we get some disinflation going from 9, let's say, to 5, they keep the rates higher than they otherwise would to make sure that we're staying at 5, and we're not going to have this V-shaped where we go from 9 to 5, bam, right back to 10 or 11. And then you're in the same problem, the same boat. But then market expectations are probably quite a bit different. So this is what Zoltan was saying in his investor note. The risks are that Powell will try his very best to curb inflation, even at the cost of a depression, not a recession, a depression. And then he risks not getting reappointed. So some different takes, some different views from Zoltan, as always. And I guess, number one, it's great to hear what he has to say, because he has very interesting ideas. You got to give him a ton of credit for, and Luke Groman, with their predictions on how Russia would play the game against the West as far as leveraging their nat gas, their oil, potentially denominating in rubles. I mean, no one saw that one coming except for Groman and Zoltan, and that maybe denominating in gold, all these things. So I enjoy his take, that's for sure. Would I say he's right? I get the supply side. That makes a lot of sense. But I just cannot see the Fed taking rates to 5 or 6%. I don't see a world where they have to do that in order to decrease aggregate demand to the point where the CPI comes down to a politically palatable level. If the U.S. economy revolved around incomes as far as the purchasing power, that would make a lot of sense to me, like it was in the late 70s, excuse me. But now the U.S. economy is so dependent on asset prices for purchasing power, therefore aggregate demand. You just think about what the stock market would do if they took rates to 5% while they're doing quantitative tightening. And I think the stock market goes down by another 20 or 30%. I think risk assets, crypto probably would take another leg down, but that just wipes out people's 401k and potentially starts wiping out their home equity. Now, again, the pushback there as well, maybe increasing rates would bring down mortgages, but then we go into an environment that I explained in my last whiteboard, or one of my last whiteboard videos, where just because we have cheap money doesn't mean we have easy money. Those two are completely different. Interest rates could be at zero, and it could be impossible to get a loan, just like it was for me in 2012. It may be very, very easy for a hedge fund to get liquidity or to get dollars, to get a loan, but it's impossible for people in the real economy. So we go into that environment where you've got cheap money, but money is extremely, extremely tight. And in that world, I think you see asset prices absolutely plummet. But that's why this macro game is so interesting and so fun. So there you go, guys. That's what Zoltan is saying. Maybe we'll do a whiteboard on this article for Thursday. You'll have to stay tuned to find out. Hope you enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you on the next video.